You're watching Trading Day. I'm Amber Canwar. We're tracking Canadian Apartment REIT, one of the REITs that have held up relatively well in an environment where investors have generally been concerned about real estate amidst rising interest rates. Now that we're seeing potentially lower interest rate, what does this mean for the REIT sector? For Canadian Apartment REIT, for example, it saw a little bit of a decline in occupancy, though it's still pretty robust at 98.3%. Rent growth, however, is slowing, and the CEO said that rents are peaking out. Against this backdrop, Canadian Apartment REIT has been trying to high-grade its portfolio, exposing itself to maybe a higher income earning type of renter. Let's bring in Mark Kenney to talk about all of this. He's the president and CEO of Canadian Apartment REIT. Mark, thanks as always for joining me. I'd like to start, if we can, with just a State of the Union, because it is interesting to hear you talk about the fact that we might be seeing a peak in rents. What's informing that? What are you seeing on the ground?
Well, we all know that the Canadian housing crisis is a very complicated one. So what we're starting to finally see is the events of a couple of years ago. So as COVID kind of lifted and construction picked up, you had a release of new condominiums coming to market, especially in places like the GTA. And that increased supply, which is probably going to peak, or I think it's due to peak in 2025, of a mass amount of deliveries of new accommodations at the same time that you've got other condos going into rental pools, and just the market has a lot of product.
So a lot of supply to absorb. What does that mean for rent? Does that just mean slowing growth for rent? Does rent come down?
Well, the growth, so when you look at condominium rents, and this is where a lot of the headlines are coming from, what you've really got is a situation where in the plus $5 a rent market, I think you've got the effects of inflation showing up on folks as well, just in terms of affordability at the ultra high level. Okay, so when you're talking $5,000 a month now for a 1,000 square foot apartment in Toronto, with inflationary impact, folks just have less money to spend even on things like rent, and so the market is pushing back. Okay, that is creating a problem at the high end of the market. But at the more affordable rent level part of the market, you've got still very, very strong fundamentals. And it's important to note that, again, I'll talk about Toronto because that's where you're seeing most of these impacts. In 2026, you have a massive decline of deliveries, and 2027 even more so. So we're going to be right back in this hot demand part of the sector 2 years from now, once the 2025 condos are absorbed into the marketplace.
Do you think there's anything policy-wise that will change that in 26, 27? Because that is a stated objective by pretty much every level, is to increase supply.
Well, listen, ultimately, development in Canada is driven at the municipal level, okay? And the biggest cost input for construction are development charges and the speed at which property is zoned to allow property to be delivered. So a lot of folks turn to like developers solving the problem or the federal government solving the problem. In the area of zoning, it's municipal. And getting those municipal development charges and the speed of which land is zoned is critical. We have a lot of land in Canada. A lot of land, and it's not expensive. It's just not zoned to be on municipal services. And so the municipalities hold the cards here.
What about lower interest rates? How does that factor in? Does that, I have to imagine it makes it easier, at least financially, to feel like you can greenlight projects?
Well, this is the other problem. When I say complicated, like a lot of the properties that we are currently buying, we are very confident that we're buying these properties below replacement cost. How can you buy a brand new building below replacement cost? Well, those buildings were built with construction contracts of 5 and 6 years ago, okay? But what we're finding is the reason that these properties are available in the marketplace is the developers that were building them are now subject to interest rate impacts that they can't absorb. They never expected rates to be at these levels, especially development financing, and they're being forced to sell. So in an environment where you're able to buy buildings below replacement cost, why would anybody build? And this is the problem that Canada faces right now, is that the entire environment has been complicated by zoning, by rate impacts, by inflation, by a whole government intervention. A lot of different factors are playing against us right now, and it's a matter of getting through this storm.
As a company, though, it seems to be working for you because you're selling, as I mentioned, you're high grading the portfolio. Just walk us through what that looks like. You sold a bunch of assets for $740 million. You're buying assets for around $400 million. What's the swap here? Where are you taking the company from a strategic positioning perspective, given all these dynamics you've talked about?
So the new construction buildings there are a couple of exceptions, but the ones that we've been targeting are in the $2 to $3 a foot rent category. And this part of the market is super hot, okay? Where things have cooled, that, like we said, is the plus $5 range, unless you're in a market that has no new supply. So for example, we bought 2 assets in Vancouver. They're in neighborhoods that they're really not building anything new because they're so unique and marquee in location. Those markets are still quite strong. But when you're in markets where there's a lot of development coming to market, that's where the weakness is. So what we're trying to do is, with our older assets, we're selling them, and our most recent announcement included 3 nonprofits, where those nonprofits can buy our existing assets that are in income distressed neighborhoods where folks need help at a third of the cost, in many cases, of building new. So the government can very quickly protect certain assets from affordability crisis, and it make a quick impact at a very efficient cost. And we're using those proceeds to buy new construction and at the same time growing earnings. It's a bit of a unicorn story. Our US friends that we've met with, investors, have basically said they've never heard of this kind of strategy before, but we're growing earnings at a time that we are dramatically changing the profile of the company into an unregulated new construction market. And this is crazy. This part is crazy. These assets that we're buying, the affordability is higher here. And people say, what are you talking about? Because the incomes of the folks that live in these new construction assets are much higher. Therefore, their rent as a percentage of income is very, very affordable. The buildings that we're selling that have the lowest rents have the most income distressed Canadians, and the affordability is the lowest in those buildings. So it's a really upside down, complicated problem in Canada. We really want to see these older legacy assets in the hands of nonprofits.
All right. And